You asked a question that trips up thousands of people every single year. You want to know if you can contribute to a Roth IRA when you also have a 401k. The stakes are real because the IRS has a silent rule that disqualifies nearly 30% of high net worth investors from making these contributions. You could have a massive portfolio and still be barred from the Roth IRA simply because of how you define your income. By the end of this explanation, you will understand exactly what counts as earned income and why your investment returns do not qualify. Here is the fundamental distinction that most people miss. The Internal Revenue Service defines earned income for retirement accounts very differently than how we think about income in our daily lives. When you file your taxes, you might look at your total cash flow and see a large number. But for IRA contributions, that number is often meaningless. The law states that your contribution limit is capped at the lesser of the statutory limit or your total taxable compensation for the year. This creates a specific trap where a person can be wealthy but ineligible. Let us break down what taxable compensation actually means in the eyes of the IRS. It includes wages, salaries, tips, and other employee compensation. It also includes net earnings from self-employment, which covers business income minus specific deductions. However, it explicitly excludes investment income. This is the critical boundary line. If your money comes from dividends, capital gains, interest, or rental income, none of that counts as earned income for IRA purposes. You can have $1 million sitting in a brokerage account generating $100,000 a year in passive returns. If you have zero wages or self-employment income, your earned income is zero. Consequently, your ability to contribute to a Roth IRA is zero, regardless of how much liquid cash you have available. This creates a strange scenario where a high earner can be locked out of a tax-advantaged account while a lower earner can max it out. The logic behind this rule is that the Roth IRA is designed to incentivize current work effort, not just reward accumulated wealth. The government wants to encourage people to save from their labor. Once you stop working and live off your investments, the tax benefit shifts to other vehicles. This is why the definition of earned income is so strict. It is not about how much money you have, it is about the source of that money. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now consider the Roth 401k, which often causes confusion because the names are similar. The rules for a Roth 401k are completely different from the rules for a Roth IRA. A Roth 401k has no income limits based on your earnings. You can contribute to a Roth 401k even if you have zero earned income, provided your employer offers the plan. The only requirement is that you are an employee and the plan exists. This is a massive difference in flexibility. If you are an employee with a 401k, you can fund a Roth 401k regardless of whether you have wages, as long as the plan allows it. But the moment you try to move that same contribution into an IRA, the earned income requirement kicks in and stops you dead in your tracks. This distinction becomes even more complex when you look at self-employed individuals. For a freelancer or business owner, the calculation of earned income is not as simple as looking at your gross revenue. The IRS requires you to deduct half of your self-employment tax before you can calculate your contribution base. This means your earned income is your net profit from the business minus the deduction for half of the self-employment tax. If you do not account for this specific deduction, you might think you have enough earned income to contribute, only to find out later that you have over-contributed. The base is net of specific tax liabilities, not gross revenue. This is a detail that catches many business owners off guard. There is a common assumption that any cash flow can be used to fund a retirement account. This is simply not true. The IRS draws a hard line between income generated from work and income generated from assets. If you exercise stock options, the rules can get ambiguous depending on the type of option and the timing of the exercise. Fellowship stipends also fall into a gray area that requires careful qualification. In these edge cases, you must determine if the payment is for services rendered or if it is a grant. If it is a grant, it does not count. If it is payment for work, it does count. But without a clear distinction, you risk making a costly mistake. The most valuable insight here is understanding that having a Roth 401k does not give you a pass on the IRA rules. You can have both accounts open simultaneously, but the eligibility criteria are entirely separate. You can max out your Roth 401k while having zero earned income. In that same year, you would be completely ineligible to contribute a single dollar to a Roth IRA. This is the silent disqualifier that catches so many people. They see they have plenty of money to invest. They see they have a Roth 401k. They assume the same logic applies to the IRA. It does not. The IRS treats them as two different mechanisms with two different purposes. This rule is not a suggestion. It is a hard limit enforced by the tax code. If you contribute to a Roth IRA without having sufficient earned income, you face penalties. The excess contribution is subject to a 6% excise tax for every year it remains in the account. This is a penalty that compounds over time. It is a costly error to make. You might think you are helping your future self by putting money into a Roth IRA, but if you do not have the earned income to support it, you are actually creating a tax liability for yourself. The system is designed to prevent you from using tax-advantaged accounts to shelter investment returns rather than wages. The takeaway is that you must look at your tax return, not your bank balance, to determine eligibility. You need to calculate your total taxable compensation from wages and self-employment. You must subtract the specific self-employment tax deduction if you are a business owner. Only then can you know your true earned income. If that number is zero, you cannot contribute to an IRA, no matter how much you have in the stock market. This is the specific definition of earned income that separates the eligible from the ineligible. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.